And welcome to Talkenomics Live. We got a lot to talk about today. Let's get right to where the markets finished because it was an up and down day. In fact, there's a little bit of hesitation. We saw markets actually fall into negative territory, and then we ended in the green. Here's where the day finished up. We had the S&P 500 was up roughly 0.4, 0.5%. You had the Dow up roughly 0.7%, and the NASDAQ was up about 0.2%. We've slugged this program, Smart Money Strategies, because our guests are going to be talking about how to position yourself in the current environment. And there's the reason you need to listen to our guest tonight, Jerome Powell. We had the FOMC meeting today. We had the usual suspects, Jerome Powell's posse. They put the FOMC statement, no big surprises, no change. But here's the quote that Powell had during the presser. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. So he raised the specter of the tariffs, he raised the specter of inflation, he raised the specter of unemployment. And when we bring the guests in, we're going to ask them about something else that Powell said, because only someone like Jerome Powell can speak out of both sides of their mouth and get away with it, not suffer a paycheck problem. So let's bring in the guests to help us understand what's going on, not only in these markets, but how you can strategize going forward.
So it's really hard to plan out when it comes to equities and credit, how those are going to react. We've had this huge snapback, 11% in the stock market in the last 30 days. Mm-hmm. So we're not out of the clear yet. We're not in the clear yet, so to speak, where, tariffs are still there. The rhetoric is still there. Unemployment is coming. Empty shelves are coming. You can see behind me, I have one full shelf and one empty shelf. Maybe that's a premonition that the empty shelves are coming. Batten down the hatches here and, stay safe and stay short.
And when we get Chip reconnected, I want to ask him about what you just said, because he also said, look, you have to have a certain amount of cash to the side right now. Before we jump into what you're doing at Regan Capital with the ETFs, yep. When you talk about having that, cash to the side, at what point do you deploy? How do you determine, okay, I got, I'm going to be generous here. Maybe I got 100K sitting to the side. When do I, set the metric, let's go to work?
I'll tell you exactly when that's going to happen and when you're going to see a windfall of cash leave the sidelines. It's when money markets go from a 4 handle to a 3 handle. And we're at about 4.25, 4.30 right now in money markets. We are one Fed cut away from investors not being satisfied earning even 3.99. That's this Mendoza line, so to speak, mm-hmm. of cash moving. But look at the shape of the interest rate curve as well when you do that, okay? You're getting about 4.30 on cash. You have to go out 11 to 12 years in duration, at least in treasuries, in order to get the same yield. Mm-hmm. That's why it makes sense to still stay short, is really the shape of the curve. And reminder, the Fed has cut 100 basis points in the last 8 months. Do you know what bonds have done in the last 8 months? Do you know what the total return is on bonds since they cut?
I'm going to guess that the return is, about a 5% just since the last cut?
Since September 17th, which is the day before they cut 50 basis points, the ag is down roughly 1.25%.
It's down, okay.
So since the Fed cut 100 basis points, bonds have actually lost money. And so we have some large investors that are coming to us kind of hat in hand saying, we don't really know what we're doing. The playbook that we thought was going to play out hasn't played out. What do we do? And so, right now, that's why you stay. And I'm not talking about staying in 1 month or a money market account. Mm-hmm. You can also go buy treasury floating rate paper. You can buy corporate floating rate paper. You can buy mortgage-backed floating rate paper. There's this, pretty large universe out there of floating rate bonds that are high quality that pick up 50, 100, 150 basis points versus sitting in a money market account, and will actually benefit when the curve steepens out. Okay. Right. So you have an inverted curve, which is really bad for fixed income investors.
My answer to your question is I think betrays the fact that I am basically risk averse when it comes to investments. I take plenty of challenges and risks with my career and my life, but with investments, I've sought the stability of the risk-free investment in a lower producing U.S. Treasury. But I want to talk to you about what you've launched, because you just brought up mortgage-backed securities. And those of us who lived through the great financial correction, crisis, collapse, whatever you want to call it, will recall that mortgage-backed securities created a whole lot of hurt for a whole lot of people.
Yep.
So here, I think I actually created a kind of fun banner about the resurrection of mortgage-backed securities. They've never really left. I mean, they're part of they're necessary because you need liquidity to fund future mortgages. But let me ask you this. You've created an ETF. It's just recently, the MBSX, if people want to go look at the ticker for this. Describe to me what this ETF allows someone like me to do, because as I understand it, access once reserved only for large banks. I now have access to, and I don't understand the product, through a floating rate that I can now capitalize through the ETF. How does that work?
Right. So as an investor, you can go on to Fidelity or Schwab, click on trade, click on fixed income. You can buy a corporate bond. You can buy a municipal bond. You can buy a treasury. You can buy a CD. There is no option to buy a mortgage bond. Okay. U.S. residential real estate is one of the biggest markets in the world. It's $50 trillion. Mortgages backing those that real estate stand at about $14 trillion. So that's right. The U.S. residential real estate market, the LTV is only 28%. 72% equity is owned by U.S. homeowners. Okay. But this mortgage-backed securities market is gigantic. It's $12 trillion. It's the second biggest fixed income market in the world next to U.S. treasuries. Okay. But when you look at all of the 40X funds, ETFs, and mutual funds that can access or that are solely focused on mortgage backs, it's only about 100 billion. So you're talking about less than 1% penetration of 40X funds for individuals, but as well as, our main investors are independent RIAs that are managing money on the behalf of individuals. So, what Regan's doing, and this is our sandbox, all we really focus on is mortgage bonds. It's all I've done for 24 years. So what we're doing is we feel like we're democratizing access. We have a floating rate fund and a fixed rate fund that allow us and allow investors to access whether they want floaters or fixed.
All right. I think, do we have Chip back?
We can try, yeah.
We're going to back securities, whatever the MBS is. I think of what happened in the lead up to 2008, and I worry. I understand that there are regulations in place to protect investors, but how do you attract investors? And I realize you are dealing with very large individuals who are taking advantage in a good way with the ETF. But how do you attract investors who might have gotten burned the last time around?
Yeah, so let's take the years 2007 through 2009. 07, 08, 09. I was in New York. I was working at Cantor Fitzgerald, trading, large swath of mortgage bonds. And what blew up were non-agency mortgage bonds. Countrywide, Residential Funding Corporation, all these companies that went bankrupt, right? Because they were taking on so much leverage, and, institutions like AIG were using 50x leverage to buy these. But when you look at the agency market, and we're talking about Fannie Mae, Freddie Mac, and Ginnie Mae, they did 7% annualized returns. The mortgage-backed securities index between 07 and 09 returned 7% annualized. Okay. So in these products, we're only focusing on agency paper, government guaranteed. Lest we forget, Fannie and Freddie are currently in conservatorship, and Ginnie Mae has been a government-owned entity since 1968. So we're only focusing on agency paper. Agency, I don't want to say it's the same as U.S. Treasuries, but it's the same credit in terms of these are U.S. government-sponsored or owned enterprises.
Yeah, the applied backup, yeah.
Exactly. We do run into folks. I had a call today with Europe, a bunch of European investors. And they're like, hey, this is a bad topic, even though it was 17, 18 years ago. And you show them that chart and you're like, hey, look, let's look at what agencies did. And they're like, oh, I didn't realize that. Just like, when I ask people, what do you think bonds have done since the Fed started their cutting cycle? Oh, bonds are yielding 5. They probably made 5%. No, they actually lost money over the last 8 months. So it's really it's a lot of education. But if you take the bond index is roughly 1/3 mortgage backs. Read Barron's this weekend. Rick Reeder, his number one idea is agency mortgage backs. PIMCO, their number one idea is agency mortgage backs. So what we're doing is we're creating little silos to invest in that you can pick and choose. Oh, I want floating or I want fixed, instead of just saying, all right, I'm going to give a $2 trillion manager money and hopefully they're going to be nimble enough to move around into the best possible product.
I'm going to try and summarize this, in my kind of words, because I don't
Sure.
trade in mortgage-backed securities.
Of course.
And Chip, give me a thumbs up if you're able to follow us, because I don't know if Chip can hear me through this mic. Nope, I don't get the thumbs up from Chip yet. So Skyler, here's my question. When we're talking about your ETF, it seems to me the advantage is the liquidity. I can move in and out of the ETF in a minute. I can go in, I wouldn't do that because you can't time anything. Whereas with, the agency bonds that were sold in the past, you were stuck and a lot of people got burned. So
Right.
is the real, you've laid out very well, because you got me at the beginning of the show. I thought things were positive, and in fact the return has been negative. So you made the case with
And
the data.
I wasn't trying to get you.
No, I don't feel like I got in that sense, but
Yeah.
but
Right.
listen, I love knowing where there's an opportunity, and you've just laid out there's an opportunity. You can't lie with numbers. You can't lie with data. There are people who will manipulate it. But the bottom line, what's the most attractive, motivator? Is it the liquidity and the ability to go in and out of the ETF, or is it that the return is actually going to be better than what I can get right now in the money markets or in other places?
Oh yeah, we're talking, and since the Fed cut 8 months ago, those money market accounts have dropped a point. So when they do cut, what you're earning on T-bills or money markets, once that hits 3 handle, and it went from 5 1/4 to 4 1/4, and you can still pick up now almost 6% on agency mortgage-backed securities. They're trading at extremely wide levels, especially relative to corporates, okay, and municipal bonds. They're trading at 80th, 90th percentile in terms of wideness. But the overall theme is that, especially when you're dealing with, let's say, a $5 billion RIA, who set it and forget it for the last 20 years on their fixed income portfolio, they haven't made up their losses from 5 years ago. Go all the way back to 5, 6 years ago, and the bond market is flat. Okay. So that person, that CIO or the person in charge of your money that blindly put you into a core fixed income fund, now they can play quarterback and they can pick and choose. And it doesn't have to be private credit. It doesn't have to be risky securities, but they could say, hey, look, the ag is 30% mortgages, 30% corporates, and 40% treasuries. Why don't we put 90% in mortgage backs and 10% in treasuries, and be able to switch that up and be able to play quarterback and pick and choose the best managers in each sector versus just blindly giving cash to a large behemoth $2 trillion manager.
So when we talk about the ETF, how long you just launched it recently? How many days has it been active?
May 1st, 6 days.
Okay. I realize that it's only 5 days, 6 days that we can figure out a trend, but I was just looking at Yahoo Finance real quick, and I see that it's trading higher. If someone were to come to you and say, what are your projections? Do you give projections as to where it might be heading over the next 6 months?
Yeah, generally we're investing at, call it 5 3/4 yield. That's your base case of, hey, that's effectively what you're going to get if you're going to play this out. But then, I don't have my magic 8 ball here, and I don't know where interest rates are going to go. Neither does the Fed. The Fed has 700 PhDs, and they can't tell you squat. Just like you opened up the show, the Fed's talking out of both sides of their mouth. So it's, where you're investing at, which is 5 3/4, that's the best indicator of forward-looking yields, as with all fixed income. But if you go out and you just buy the index and mortgage backs, that's only yielding about 5. Okay. If you're buying one of the large mortgage-backed ETFs, okay, they follow the mortgage-backed index, which is a market-weighted index. So 70% of mortgages that are outstanding were issued post-COVID are paying less than a 4% coupon. And ostensibly, those borrowers are never going to prepay. Okay. So what you can do is you can go out and you can buy newer issued 5.5 or 6% coupon mortgage backs at 99 or 100 cents on the dollar. Or you can buy $80 or $70 mortgage backs where the borrowers might be more likely to prepay than those post-COVID mortgages. So it really is hey, don't just go by the ag, they call it. It's now the Bloomberg ag, used to be the Lehman ag way back in the day. Because bonds, unlike stocks, have tremendous adverse selection. Okay. Borrowers borrow at the best possible time. That's individuals, corporates, municipalities. And then they sit there, and they're going to sit there on 2.5%, 3% coupon mortgage backs. If you own index funds, that's what you own. And those are because they're indices, and a lot of the money is directed towards indices. Okay. Similar to like the Mag 7, these things are trading at, crazy PEs. You don't have to own those PEs. You can own bonds that are yielding an extra 50 to 100 basis points with a lot that are much shorter duration, much lower risk.
I interviewed an interesting real estate agent. Jenna Stauffer is actually a global real estate agent with Sotheby's International. And we were talking about what, I don't know if you know her, but she's out of Florida. And, it's an interesting market because we talked about what's happening with mortgages, with everything. And we also talked about the fact that, and I'm using Zillow, so the data isn't hard as science, but I went out there. The median value of a house in Florida, median value, has dropped year to date about 2%. Now, if you look at Case-Shiller, it hasn't dropped, but Zillow, through their valuation metrics, saying it has dropped. And I have relatives in Florida, or as my people say, Florida, who would point out to you that condos, there's a world of hurt going on there. So I want you to hear what she said about what's coming with just real estate in general. And then I'm going to ask you on the backside of this, is this going to have an impact? Because the bottom line is she doesn't see interest rates, at least for mortgages, dropping below 6%. And they're at 6.8 now. But here's what she told me earlier.
That with housing prices going down, here's the thing, we really have had such a shortage of homes. You can take this all the way back to 2008. We've had a massive shortage of homes due to so many years of underbuilding. So that's what's going to give us cushion with prices. I think we're due for a correction. We had prices that just went up so dramatically in such a short period of time. So it's really basic economics. You can't have these prices go up so rapidly and not have those wages be able to keep pace with that. You're due for a correction. You're due for a rebalance. And I think that that's what we're going to see.
The reason I played that soundbite, and we do have Chip, it's good to have Chip here. Skyler, the reason I played that is on one level, we're talking basic mortgages. But on the lower level, and this plays into what I think you're doing and where investors should be, that ears should be perking up, there's so much pent up demand for people to buy. Interest rates really aren't going to come down when it comes to mortgages. And yet, let's say we got 6.5 in the next couple of months, or at 6.5%. We're already seeing people run to buy at that rate. What happens to your ETF? And then I'm going to bring Chip back into the discussion.
Yeah, we are targeting, not only are we targeting higher yields than what you might get in treasuries or you might get in the ag or the mortgage-backed index, but I am 100% long on potential borrower prepayments, potential borrower activity. activity and prepayments are, no joke, lower than any textbook would ever say is possible. Okay. So the average prepayment rate in the US right now is about 6, in some instances 4 or 5% annualized. You go to like economics or finance 101, those textbooks will tell you it's 6. And so we're at the low, we're all literally off the Richter scale. And so you can go out and not only buy really nice high yielding instruments, call it 5.5% to 6%, but that assumes that nobody ever moves again. It assumes that nobody's ever going to refinance again and that interest rates basically stay where they're at forever. So I like that optionality. I like the upside. It's a pendulum. The pendulum has swung to about the 99th percentile. We only needed to maybe swing to the 85th percentile to make an extra 1% to 2% on a government guaranteed high quality asset.
All right. Chip, good to have you here. I've got a really top crew here that's got our technicals worked out. And I want to bring you in because there were two things that you've shared with us that I thought were really important. First, keep a pile of cash to the side. You talked about the need to do that, especially in the uncertainty we're dealing with now, because markets, everyone craves clarity, but markets crave certainty. But you've also made a profession, and a successful one of that, as an RIA in New Jersey, at finding small cap stocks and medium-sized cap stocks that are perhaps undervalued, because we all get excited by the Mag 7 and the big names. But my question to you is, when do you deploy that cash that you might have to the side? Is now the time to start looking, or should you still be holding?
Thanks for having me. So the cash and the certainty is part and pari to my investment philosophy. 1, have a strong balance sheet. 2, find things that can grow and stay opportunistic. And 3, buy low valuations. And I'm a big behavioralist as well, so buy neglect. So that kind of cash reserve that I talk about, depending on who you are, 6 to a year, I never deploy it. I mean, that is so you don't have to sell on April 3rd, 4th, 5th, and 6th to pay your mortgage or pay college. And if you don't have that kind of reserve, I'm not sure you should be in the market in general. For those that do, I told my clients to stay long and not get scared out. And the time to put the cash to work was April 4th, 5th, and 6th. I mean, the S&P's flat since the beginning of April right now. The NASDAQ's up 1.5%. Even the small caps, my SMID value, Russell 2500 value has come back just down about 1%. That said, there's always something to do in active. And if you look at the benchmark, the Russell 2500 value, there's about 1,800 names. People get scared of it in ETFs, and that's kind of a problem with ETFs in general because there's money losing stocks in it. Sure, a little over 600, but that means there's almost 1,200 stocks that make money. And so there's fertile hunting ground. There's plenty of stocks still down double digit this year that people are scared of, that they don't understand without a lot of street coverage. So stay opportunistic is what I've said. Maybe some of that rally back is in place now. So you got to extend your time horizon and be a little bit more picky. But there's things to do.
Well, let's talk about opportunity, Chip, and I'm just going to pull this out, and it's based on something you and I talked about, but unfortunately, there are very aggressive military conflicts going on across the world, and the United States needs to rearm itself, needs to rebuild its supply of ammunition. Wouldn't that be, though, a more larger cap kind of play there, or there are ways to find undervalued stocks that might take part in the rearming and the rebuilding of U.S. military preparedness?
Oh, so there's a supply chain and there's tons of companies. I won't talk about things under, too much under $1 billion in cap, but there's tons of little small cap companies, micro cap companies I have in the defense chain with net cash on the balance sheet that are seeing sales accelerate. You have companies like Raytheon outsourcing contracts that have been shut down when they restart. I think you've heard all the big primes say spending's accelerating. The continuing resolution accelerated defense spending. The budget that they're considering now is accelerating defense spending. So there is a chain. The other side of it's not just defense, it's commercial, right? I mean, Boeing and Airbus have been their own worst enemy. We talk about this concept of going from good to great. Boeing's got to go from horrible, terrible to just pretty bad, then to kind of bad. And they've got over a 5-year backlog. And the problem their customers have with them is they can't get delivery of the planes they've been promised. So with this whole China snafu, India stepped right up and said, hey, anything China can't take, we'll take. So, the companies that I look in the small mid-cap universe play into those change, into the supply chain, and there's plenty to do. It's just, you don't have to stay in large cap.
Chip, I don't go anywhere. I've got a hard out with Skyler, so I want to ask the two of you a question and bring Skyler back into this.
Sure.
And I want to come back to some of those small caps once Skyler, he has a family obligation. We're going to let him meet. You don't want an angry daughter at you. But Skyler and Chip, and let me start with Skyler on this one. When we talk about what the United States is doing, President Trump today, it was reported by CNBC, is talking about rescinding the Biden era tariffs and prohibitions on selling high-powered chips, the NVIDIA chips basically, to China. Now, this could be an overture because we have the meeting coming up in Europe between the USTR and the colleague from China over the tariffs. But how do you as an investor, when the president goes back and forth, he says one thing and then he does another, how do you keep your feet balanced? Skyler first.
You got to stay the course, like Chip talked about, and how he's dealing with his customers. You set out a plan, and the best thing to do is to wait a little bit, and because he's going to go back and forth, whether it's a 72-hour rule or a 1 month or a 3 month rule. Set a rule for yourself, just like you might set out a financial plan or an asset allocation plan. Set a rule for yourself where I'm going to wait 30 days to actually react to this. Okay. You're not going to be benefited by, short-term reactions and moving your portfolio around. But going back to, generally, how are you going to stay safe? Stay short, have that cash position. I think you can beat that cash position in short duration floating rate paper. Stay high quality in those sectors. You can even go and buy treasury floating rates. I call it a free lunch. You can pick up 15 to 20 basis points owning treasury floating rate notes versus owning T-bills or owning a money market account. So keep that, and maybe you should be building up that cash pile here from maybe 5% up to 15%, which will allow you to buy those dips that we saw earlier in April.
Chip, how would you respond? Because I get the sense that if I were your client, I would be your ideal client because I'm a long-term, I'm a set it and forget it. I would check in with you twice a year, but I would be the long-term client. Is that how to play this, or do I need to be much short-term focused?
So I agree with what Skyler's talking about on rates. I mean, stay short. And again, I have my clients pretty much under a year. You don't get paid to go out. And taking the conversation a little differently, and I won't stay there, Trump's concerned about the budget and the deficit. And I think that's where this tariff situation is coming from. He wants to grow GDP to raise, income. He's talking about raising taxes on the high over $1 million to cut the deficit. And Elon Musk is in Washington trying to cut his spending because of the deficit. So the long rates, I don't know. I wouldn't step up and buy a 10-year treasury here. When you can stay short, on a 6 month, 9 month. And I think Skyler said you can get, some pretty, relatively safe. There is no safe, right? But I mean, relatively safe in some of the things you talk about, agencies or munis with equivalent yields and short durations. But for the cash that you don't need to keep in cash, it is stay opportunistic, look long-term. This whole market is suffering for what I call short-termism, and that's a 30-day, even single-day options. That doesn't make any sense. It's just that's akin to gambling, and I can't put my clients' money there. But if I make time my ally, take a 2 to 3 investment horizon, have reasons to be there as far as a solid balance sheet, can grow revenues and earnings and ROIC, it is undervalued. That is how you can stack the odds in your favor over the long term. And when you start thinking long term, you can look at some of the damage that was done after Liberation Day and say, boy, that's kind of crazy that this stock has 95% domestic revenues and has said that tariffs won't be an impact, and it's still down 20% a year. So maybe I'll go there.
All right. Before we continue, Skyler, thank you very much for being here and for putting up with some of the issues we had at the beginning. Is there anything you want to, before I let you go pick up your daughter from the soccer game, is there anything you want to add? And congratulations on launching MBSX.
You know, when I'm talking to clients, the U.S. economy is extremely strong, okay? Corporate leverage is lower today than it's ever been in history. Debt to market value of U.S. corporations is roughly 18%, lower than it's ever been. LTV of U.S. real estate is at 27%. Borrowers have never had more home equity than they have today, and now 65 to 70 years. So when you look at net wealth and the health of the U.S. consumer and U.S. corporation, it's extremely strong. And what we focus on, mortgage backs, these are tariff proof. You know, these aren't borrowers that are building new homes. These are borrowers that are already in their homes. They're not worried about labor and lumber, and copper. And so there's this huge asset class out there that's 11 or 12 trillion dollars. And, you know, it's still a boogeyman in the closet. Oh, this caused the GFC. Well, I'm going to put my money in a bond fund. Well, lo and behold, you know, your bond fund's a third mortgage backs. And you can find some really nice high quality assets out there that pick up 100, 150 basis points versus treasuries. Because guess what? The banks and the U.S. government aren't buying them right now. So, you know, there's still a lot of opportunity out there, even in very large asset classes. And the U.S. consumer and U.S. corporations have never been better in any of our lifetimes, legitimately combined.
Skyler Weinand, thank you so much for joining us from Regan Capital. And the empty shelf behind you is a good analogy to what we may all be facing with these tariffs. I'm going to continue the discussion with Chip, and I wish you the best, and I hope you consider coming back to Talkenomics in the future.
Awesome. Thank you.
Chip, you know, so picking up on the tariff situation, the potential for the supply chain disruption, we're already seeing that. But the average American, we're being told by the media that it's going to get worse in the next month to 2 months. Is that driving investment decisions at this point? Because I don't think any of us understand what that truly means, that it's going to, quote, get worse.
Well, so there was panic post-Liberation Day, right? I mean, my clients were talking to me, what's going to happen? You know, the media was telling us it was a Great Depression, tariffs started the Great Depression. And look, tariffs can go wrong. And if he pushes too hard, things can break. I think you saw the bond yield spike you talked about earlier. I think that was hedge funds. I don't think that was China and Japan dumping treasuries. I think it was hedge funds getting offsides or people covering their margin, which I don't think is really ever a good idea for an individual investor. But I think at this point, we have a 10% tariff on most of the world. Investments going over to China or going to talk with China now about de-escalating. I think you will see prices go up. And I think what I'm listening for when I look at companies is who learned from COVID, right? I mean, we had a situation where supply chain shut down 5 years ago. And if you're a management team getting on the call and saying, oh no, it's like, talk about the great management teams are the ones that have gotten out of China and have gotten a home and have diversified into dual sourcing. Plenty of companies have that message now and are talking about mitigating tariffs and potentially gaining market share from those who can't. That's the beauty of being active. You're not stuck in an ETF mindset where it's good or it's bad from a high level.
So let me ask you this, and I'm glad you brought up the management. I'm going to interpret what you said as Tim Cook and team at Apple, shame on you. I was cursing them yesterday because I opened up the drawer and I have wires and chargers that don't work anymore because they're obsolete based on how they change the charging device repeatedly. But Apple, it's a two-part question, but when you talk about those companies that failed to anticipate what we're now seeing in the shift, Apple's going to produce iPhones in India. They would seem to be 5 years late then, if I'm hearing you correctly.
Not necessarily. And again, I don't own Apple, so I haven't been following it quickly, but I think I heard Apple say everything they're going to produce for the US is going to come from India. That I think is new in the last 5 years, and that's what I would call a good management outcome if that's what happened, because we're close to an India deal. We might have zero tariffs with India, and if Apple supplies phones from India to the U.S., there is no tariff issue on Apple phones. Now maybe pricing will get adjusted. Who knows how it all washes out? But that's what I'm talking about. And the companies that stuck in China and never tried to move, or kept one factory, or didn't get their Canada or Mexico plant compliant with USMCA to the extent that they could, they should have. And now you'll see a scramble to do such.
And real quick, there was news today because of a trial involving Alphabet, but Apple apparently is considering using Perplexity and other AI agents as part of its search in Safari. And what we learned is that they are paying Google $20 billion a year, but that's going to start being diminished because people are no longer searching quite the way they used to. For the Mag 7, and I know you get upset with people who focus only on the Mag 7 because you do specialize in finding those undervalued stocks in small and mid cap. But that kind of news on an Apple, that would have ramifications because a lot of index funds are heavy to the Mag 7. So what did you have you heard about this? It broke around 3 o'clock this afternoon.
So I don't own Apple, but I have heard, and this is not new news, that Apple's been paying Google, right? Or and there's been a revenue source there, and so that's in jeopardy. Theoretically, active investors should have known that we're in Apple, and I don't know how much of the news is fear and liquidity, and how much is really new on that one. But that's what I would dig into if I own the stock. To your point, the Mag 7 are about 30 to 32% of the S&P 500. So when you start talking about the market, and you kind of mean the S&P 500, which isn't the market, you're talking about the Mag 7. And for those that think they're diversifying by buying an ETF of the S&P 500, they're buying the Mag 7. I mean, those names dominate. And so you do become kind of an active investor when you buy the S&P 500, whether you like it or not. I think you kind of have to have a view on the Mag 7 if you own that ETF. And I think the whole point of owning an ETF is you don't have to have a view on the stock. So with the concentration and the weighting, I think it shows some of the problems that can happen with ETFs. And it's been a good index in the past, but maybe some of those valuations have to catch up with those stocks, in my view.
When you talk to your clients about mid to small cap investments, do they want to hear that? Because the world has been so focused, NVIDIA, Tesla.
I think I think people like fresh ideas, and I'm not saying you can't own the S&P 500 and you can't own any of the Mag 7. The stocks are good stocks, and trust me, I think AI will probably be a bigger game changer than the internet was, as far as when it was introduced in 2000. I mean, I've seen every business and every student I know incorporate it into their workflow in their life. What I'm saying is, if you don't confine yourself to a group of 7, there's plenty of places down cap that either are making chips or supplying power or building data centers or laying cable or any one of a number of things using AI for their businesses, either to balance their accounts or improve their efficiency or improve their supply chain. There'll be a lot of places where that efficiency can ripple through, and those opportunities, I think, are still on the come. So, that's just for AI, and then you have companies that can take advantage of supply chain disruptions, and you have companies that won't be impacted at all by the supply chain. So you open your universe from an S&P 500 to when you go down cap. I think my universe is in excess of 5,500.
Were you always focused on, these undervalued small and mid cap stocks throughout your career, or is that why you launched Rewey?
I launched Rewey. So I launched Rewey in 2019. Nobody wanted value stocks. That's when the S&P was kind of ripping and value was out of value. Value was out of favor. So now I've got 6 years in and my results have been pretty good. And I think now, before this tariff situation, we start to see a rotation away from the S&P 500 and maybe it was rebalancing because people had made money. Maybe it was rebalancing down because people don't own this area. I mean, if you own the S&P 500, you don't own many small caps. And again, you have index like the Russell 2500 or the Russell 2000 or the Wilshire 5000. There's lots of other names out there. And if you stay in the S&P 500, you're limiting yourself to somewhat. Again, and that provides active research. These names are neglected. A lot of them don't have the sell side coverage. A lot of them don't have much sell side coverage. And I think if you do your own work, you again, and follow a philosophy, you can stack the odds in your favor.
I do want to talk about one large cap stock, and that would be Disney, because I think they blew everyone away today. They certainly have had some issues, but the theme parks did very well, what they now call the experience. But I remember back when around 2018 or 19, the revenue picture just for the theme parks was huge. And it's not quite where it was prior to COVID, but it's getting there. And now we have the tariffs. And they're certainly going to take a hit from international travel. If you had a client who came to you and said, look, I like Disney, would you try to steer them away from that kind of discussion, or what would you want them to consider?
So I don't own Disney. I haven't done the work on it. From what I know, they've been pursuing streaming and have trying to compete in that world. And I think they're opening a big park in Paris, and they just announced
Dubai.
They just announced a big part. It was all over the news this morning. It'll be in Dubai. It'll take 7 years at least. I think if I had a client that wanted to own something, I'm akin to people having their own stuff. I have lots of clients that want to keep certain positions in their portfolio. I would just try to say, look, understand why you're owning it. It's not just Disney. If I had it forever, it's here, the big building blocks that make up Disney, and make sure you're okay with those.
And so I don't want you to cross any threshold that, the compliance issues are very important. But if there are small cap names that we should consider that you could share with us, whether you cover them or not, are there some out there that you think, hey, this is a good one to take a look at, do the research on this?
So I'll give you two things. One, I think, is this commercial aerospace and military. There's a stock we own for clients called Ducommun, ticker is DCO. It's about almost half and half military and commercial. They sell to Boeing and Airbus. Their biggest customer is Raytheon. They had a good earnings announcement, and the stock responded. And they've got some good long-term goals they're going to try to execute again. So I see a 2 to 3 year horizon. And so, there's, you can see the chart, and it's not kind of above a high. So, that's something, if somebody wanted to do some work in that area, or you could put up, show me the comps, and you'll get 5 other names to look at. And I may be involved in a few of those, and clearly I'm down cap. The other area I think people can look at are U.S. regional banks, and picking up a little bit on what Skyler said, the banks are very healthy compared to the great financial crisis. I mean, they've tripled their capital levels. Thank you, Elizabeth Warren, right? They haven't chased crazy loans. I mean, the private BDCs and leverage credit funds have used the leverage, and the banks haven't. They are regulated. And tonight there was another story, and I haven't dug into it, but the Senate just voted to undo an OCC bank regulatory merger prevention that Biden put in. So maybe this deregulation can spur some bank deals. And bank deals generally over the last 6 years have been positive, because you're consolidating all of the assets off of one platform onto another. And there's a lot of cost takeout and a lot of synergies when you do that. And I think the capital levels at regional banks are pushing 11%. The yields can push as high as 5-6%. And they're still out of favor because people remember the financial crisis, or they remember Silicon Valley Bank, which was a hedge fund or a venture fund or whatever you call it, wasn't a bank that matched its assets and its liabilities. So I see a lot of neglect in that group as well. And there's stocks that aren't so small cap there, but 4, 5, 6, 7 billion is a good group in there that I'm talking about.
And last question for you is more of a broader topic, because you and I, when we spoke a couple of days ago, we were talking about the tariffs. I the question that nobody can answer, but I'm going to ask you: how long should your clients, should investors, be patient with the tariff negotiations to figure out what the next part of this is going to look like?
So again, I think, look, the markets have told you we're back to pre-Liberation Day levels. And I think people think the reciprocal tariffs, and this is my view, I think they think they're not going to come back. They might keep this 10% level, and I think the market can digest that. I don't think you'll see a 10% price rise. Remember, it goes into COGS. There's cost cutting and moving stuff around. So you'll see some price increases, but maybe not the full impact of the 10. China's a wild card. Besant's going over there to start the conversations, and I think they have to move. Where that winds up is a risk. And if we don't get anything, that might be a downside catalyst to the market from here. And I think if we roll around, is it July 2nd and the reciprocals come back on? I think you can see risks. So there's risks, but when you look at 2 to 3 years, the risks aren't as bad, especially if you have a company with a good balance sheet, has the ability to grow, and at this point is undervalued and perhaps neglected or feared or just unrealized by other investors, meaning there's some good news to come or others can discover it.
Chip Rewey, I think the key factor that people should consider with an investment advisor like you is patience. And God bless you for being patient with us during the technical issues. I really appreciate your sticking around so that we could have this discussion.
No worries, and thank you for the opportunity. Again, if you have a long-term plan, it should be a long-term plan. I tell my clients, if you're up at night, you shouldn't be, right? You've got a long-term plan. All right, Adam.
Chip Rewey from Rewey Asset Management, RIA in New Jersey. All the best to you. Thank you for joining us. And thank you to my team here at Talkenomics Live for helping us get Chip in so that we could hear his thoughts. And I hope he will consider coming back. We will see you next week, Wednesday, live here on X, YouTube, LinkedIn, Facebook, and Rumble. We stream every week.